tax payable is what you actually owe to the authorities, and tax expense is what shows up on your income statement. So whatever is computed with your accounting rules, then you're already a few miles ahead. Because this understanding of the difference between tax payable and tax expense makes everything extremely clear. Over time, both converge, but at any given time in the year, they can differ because of temporary difference. For example, how depreciation is treated for tax versus accounting purposes. I'm going to give an example. Suppose that tax allows you to depreciate an asset very quickly, but your accounting policy is slower. So at the end of the day, it will be the same. The residual value after 5 years will probably be exactly the same. But in the early years, especially at the beginning, there will be a difference, because with the tax, if you can depreciate faster, then your taxable income, because it reduces, the depreciation reduces your income, will be lower than in your accounting income. And as a result, what you will pay to the authority, the tax payable, will be less than the tax expense. So in reality, what is happening is that you're paying less tax in cash now to the authority than what your accounting would suggest. So you're basically getting a tax break today that you will eventually have to give back later when the depreciation slows down and the taxable income becomes higher in accounting income. So yeah, in this case, it creates a tax liability because it's something that you will have to pay in the future. And you can think of it as a tax bill that was postponed to the future. You have an obligation to pay more tax later when this temporary difference reverses. And tax asset is the opposite idea. You have probably to practice a bit, but once you get tax payable versus tax expense, which one is higher at a given time, then everything falls into place quite easily.